Front and center this hour, the record high playbook. As the second half is about to get underway, we debate the road ahead with the investment committee. Joining me for the hour, Joe Terranova, Steve Weiss, Jim Lebenthal. We will go to the markets. We're green across the board. Our question is, what happens now? We've been able to claw our way back from those lows in February. Goldman Sachs' Tony Pasquarello, guys, says the path of least resistance is higher. Morgan Stanley's Mike Wilson of bearish past says still bullish on a 6 to 12 month horizon. And even our resident bear has come around.
I prefer resident Grinch.
You are the Grinch.
Yeah.
Dracula, the Grinch, whatever the audience wants to call you today, they can call you. This is cable, so they can call you anything they want.
Anything they want.
You've fully kind of capitulated. I mean, you're fully invested.
Yep.
And whether you are comfortable with that or not,
yep,
you're playing this game as though the market's going to continue to go up.
Yep, and I've been fully invested for a while, but when I'm fully invested, you get kind of nervous, right? Particularly when you have the amount of beta that I have in the portfolio, given the tech names that I own, which comprise the majority of the portfolio, the vast majority. But, this is really just an interesting market, and I've talked about it before. I think we have a new cohort of investors, over the last, 15, 17 years are just used to V-shaped recoveries. And that's probably the right thing to do, because that means you're always staying invested.
Yeah.
You're buying on the dips.
Let me ask you this question.
Yeah.
I'm going to ask you to be a little introspective. I know it's difficult for you
to
do that.
Very difficult. Wait, let me call my humility.
What do you think that you and maybe some of the others who are more cautious underestimated about the market environment from where we were at the depths in February?
I think I underestimated their tolerance for chaos, lack of direction, and risk. I mean, you still have corporates frozen. We just heard the CEO of HSBC in the U.S. talk about not really a lot's going on. There's a lot of uncertainty among institutional investors, and that preys on CEOs who are loath to invest major capital into their growth because they don't know where you'll be able to grow. And supply chains, they're moving. They're not frozen, but they're moving not the way you want them to move.
But if you invested, I don't mean you personally, but if the typical viewer invested based on what the average CEO or average hedge fund investor said over the last 6 months, you'd have missed a good portion of this move because there's been a lot of caution. Certainly, as you said, on the institutional side, there's been a lot of caution in the C-suites, and much of what they've been cautious about hasn't materialized in large respects.
Yeah, and to be fair, I don't really care what the average hedge fund manager is, but I know exactly what you mean.
The point I'm making is where sentiment was from those cohorts.
Yeah. Sometimes it takes a while for things to play out. So it's not instantaneous. And that's why I'm still cautious about this quarter's earnings, what the guidance will be. Now, I do believe they'll get a reprieve, despite Trump saying he's not going to extend past the July 9th deadline. We know what the narrative will be. I've got so many, potential trading partners or ex-trading partners, whatever terminology, that are so close to the deal. They're showing good faith. I want to give them a little more time. Because keep in mind what the narrative has been 2 months ago. We have 20 deals that are going to be announced this week. We haven't seen really anything. We've seen some sort of a deal with the UK. Our top trading partner, our friendliest ally out there, give us something, but not much. So I think as long as you avoid just a really strong case against trade, right now people are comfortable with the 10% baseline tariff increase.
Joe? So we hit these record highs. We're going to turn the page to the back 9 of the year. What are we set up to do?
I think at some point in the second half of the year, we'll have a correction, and I think you buy that correction. I think we have a much healthier market in 2025 than we had in 23 and 24. At the midpoint of 23 and 24, what were we talking about? We were talking about 7 to 10 stocks that you can invest in and the struggles for the rest of the market. Now, when you look at the market, there is a much healthier, diverse opportunity set. It goes beyond just equities here in the United States. If you look overseas, you'll see opportunities in Europe. Germany's outperforming, up 20%. UK up double digits. You've got Spain up double digits. Hang Seng up double digits. Even here in North America, Brazil, Mexico, Canada outperforming the U.S. And we've had these concerns about fixed income. Well, taxable fixed income is doing great so far this year.
Let me stop you for 1 minute, because you're making a comparison. You're pointing out how strong things are, how great things are in the market. I'm wondering if you look below the surface, whether it's actually as strong as the record-setting move would suggest it is. And since you brought up 2024, underneath the surface, the number of New York Stock Exchange net new highs this prior Friday only reached 70, plus more than 370 in November of 2024. 70% of Russell 3000 stocks were trading above their 200-day average when the S&P 500 first rallied above 6,000 in November of 24. That number narrowed to 59% into the market's divergent February peak and only reached 45% last week. Those numbers would suggest that this is not nearly as strong a market now as it was in the period that you're pointing out.
So you're just specifically looking at the S&P 500. I'm looking at.
Well, I said the Russell 3000.
Well, the Russell has struggled and has struggled over the last several years because it doesn't have the earnings growth. I don't think just because you don't have in equities themselves the type of participation that you had in November. And by the way, remember in November you had the head fake in the Russell. In November, it looked like healthcare and other sectors that had been underperforming would actually participate, and they're actually not. So I don't know. I'm looking at it from the standpoint of how do you do asset allocation in a portfolio, and it looks pretty good to me because, as I said, it's not just equities, it's fixed income, and it's a lot of different places that you could go. Also, volatility has basically remained the same. And by the way, as it relates rather to the volatility in the Treasury market, we sit right now for a U.S. 10-year at 4.27. The average for a 10-year over the last 24 months is 4.27. So where have we really gone? Maybe to a lot of different places, but we ended up in the same spot.
The point of me bringing up those numbers is the higher stocks continue to go higher. You're not getting the bottoms-up breakouts. The
momentum's leading.
Well, momentum's leading. Higher beta, lower quality is leading.
Sorry, Jim, but just because momentum is leading, that's not an indication that the market is reaching at an inflection point. When momentum rolls over, I'll be the first to say that you're reaching at an inflection point. And yeah, you're right. Some of the quality names are not performing right now. But I don't think we're getting to the exuberant level that we got in 21.
Joe, I'm with you on this, okay? And look, the numbers that you stated are the factual numbers, but there's a lot of stocks that in 2024, 2023 were absolutely left behind, did nothing, that are performing well right now. You can look at sectors, financials just as a sector. You can look at more value-y, and I know this has been talked about a lot in the last couple of weeks, value-y tech stocks like a Cisco, some of the non-AI chip names like a Qualcomm, like an AMAT, things that really have been left for dead are actually now performing. Industrial. So yes, there is, Scott. There's.
I know, but industrials aren't a value. Financials aren't a value. They're both at highs.
I would
both
disagree.
at highs.
Factually, they're at highs. I still think they're a value. I mean, certainly if you look at financials, industrials, a little harder to make that case. But financials, if you're looking at a lot of these stocks, you're talking high single-digit multiples, high dividend yields. Yes, a little bit of a premium to book. I'll give you that. Industrials, look, most of them are now in the high teens, bordering on 20. If you talk to me, and this is Steve, you talk about a new generation of investors. If you talked to me 10, 15 years ago and said industrials trading at 20s are value, I would have disagreed. But we're now 10, 15 years past that, and that's where these things trade. And that's cheap to the market.
One of the things I put in my note to you this morning was that the additional comfort in the market is that the rally has broadened. So with that, people that just don't invest for tech because they're afraid of the volatility, even though I look at volatility as risk, now have places to go. Industrials have done well. Financials have done well.
The big ones.
Right. The big ones.
That's part
exactly.
of the thing. If you look at the S&P versus the equal weight, it tells a pretty distinct story.
Yeah, and that's where the additional comfort they need comes in. So they want to go into the big names. The small names they catch up when the markets are correct. And then the junk, I'm not saying they're junk, but generally the ones that are less popular will move and lead that recovery.